Closing stock. So, first one is closing stock. The closing stock represents the cost of unsold goods lying in the stores at the end of the accounting period. The adjustment with regard to the closing stock is done by crediting it to the trading and profits and loss account and by showing it on the asset side of the balance sheet. The adjustment entry to be recorded in this record is closing stock account debtor to trading account, and based on this is a record like closing stock account debtor to the trading account. The closing stock of the year becomes the opening stock of the next year and is reflected in the trial balance of the next year. So that's it. It's a first adjustment theory, closing stock. Let's move to outstanding expenses. When expenses of an accounting period remain unpaid at the end of an accounting period, they are termed as outstanding expenses. So, when expenses of an accounting period remain unpaid at the end of an accounting period, they are termed as outstanding expenses. That is, concerned expense account debtor to outstanding expense account. The amount of outstanding expenses added to the total of expenses under a particular head for the purpose of preparing trading and profit and loss account. Let's move to prepaid expenses. This portion of expense carried forward to the next year and is termed as prepaid expenses. The necessary adjustment in respect of prepaid expenses made by recording the following entry. That is, prepaid expense account debtor to the concerned expense account. Hope it's clear. The effect of the above adjustment entry is that the amount of prepaid part is deducted from the total of the particular expense, and the new account of prepaid expense is shown in the asset side of the balance sheet. So now we have studied closing stock, outstanding expenses, prepaid expenses. So in closing stock, we do have closing stock account debtor to the closing stock account debtor to the trading account, and in outstanding expense we do have concerned expense account debtor to the outstanding expense, and then coming back we do have prepaid expenses, prepaid expense account debtor to the concerned expense account, that is journal entry. Then coming we do get it's prepaid expense account is shown in the asset side of the balance sheet, and in accrued income we will like income that are earned during the current accounting year but have not been actually received by the end of the same year. Such incomes are known as accrued income. The adjusting entry of the accrued income is accrued income account debtor to what? It's debtor to the concerned income account. The amount of this is the journal entry. It's very important. Accrued income account debtor to the concerned income account. The amount of accrued income will be added to the related income in the profit and loss account, and the new account of accrued income will appear on the asset side of the balance sheet. Asset side of the balance sheet. Asset side of the balance sheet. Then coming to the following one, let's income received in advance. Next one is income received in advance. The portion of the income which belongs to the next accounting period is termed as income received in advance or unearned income. It's a key term. It's unearned income. Income received in advance or unearned income. So income received in advance is adjusted by the recording following entry, that is concerned income account debtor to income received in advance. That is the new income, new account of income received in advance will be shown where it's the liability side. In the liability ഇത്ര നേരം like ഇത്ര നേരം പഠിച്ചോണ്ടുന്ന asset side ലായിരുന്നു. Let's now it's in the liability side of the balance sheet. And when it comes back, like when it comes to the next one, we will find that it's depreciation. Depreciation we have already studied. Is depreciation is a decline of the value of assets or account of wear and tear and passage of the time. It is treated as a business expense and is put in the debited to the debited to where profit and loss account, debited to profit and loss account. The entry for the following depreciation is depreciation account debtor to what? The concerned asset account. It's very important, guys. Next one is next one we are going that okay, let's where will be in the balance sheet the depreciation will be put, the assets will be shown in the cost minus of that, and the asset side of the cost minus of the depreciation. And the last one is interest on capital. The main basic of interest on capital is a proprietor may like to know the profit made by the business after providing for interest. After providing the profit, after the proprietor may like to know the profit made by the business after providing the interest on capital. In such a situation, interest is calculated how at a given rate of interest on capital as at the beginning of the accounting year. If, however, any additional capital is bought during the year, how it will be considered? The interest may also be computed on such amount during the beginning of the accounting year. Right on, like during not the beginning, from the date on which it was bought in the business. Such interest is rated as what? Expense for the business. So journal entry is like this. It is rated as expense. Keyword expense. It is rated as expense. And interest on capital account debtor to capital account. This is it. In the final account, it is shown as an expense on the debit side. Expense on the debit side. Expense on the debit side. Expense on the, it's shown as expense on the debit side of profit and loss account. As shown and added as capital on the where balance sheet. That's it. These are the main adjustment theory, and it will be asking for 6 marks and study it.